Welcome back to the channel. I'm Alex, your go-to guide for achieving financial freedom through smart stock market investing. Today, we're diving into one of the most powerful lessons from Warren Buffett, the 12 biggest investing mistakes that almost every investor makes, and how to avoid them. I'll also share a few of my own investing sins along the way, because being honest about mistakes helps us all learn. Let's get started. 1. Trying to time the market. Buffett often says, "Charlie and I don't follow the market." He points out that focusing on where the broad market will move is important. Yes, but is it knowable? Probably not. Trying to predict interest rate moves, inflation, wars, or pandemics is a gamble. Instead, concentrate on what you can know, identifying strong businesses at fair prices. So stop worrying about when the market will go up or down. Focus on the ships, not the tide. 2. Getting hung up on your purchase price. You bought a stock at 500 rupees. Someone else bought the same stock at 300 rupees. Guess what? For decisions going forward, it doesn't matter. What matters is what the business does from now on. Whether you're up 100% or down 40%, the share doesn't treat you differently. Buffett says act like you're starting with a blank slate, no attachment to your entry price. 3. Expecting aggressive growth. Forever, lots of companies promise 15% plus annual growth. But Buffett warns how few large companies actually deliver that consistently. If you pay a high price expecting massive growth, you're taking on risk. Growth is great, but growth at any price is a trap. Be realistic. Focus on businesses with durable models, not just flashy forecasts. 4. Overusing leverage. Buffett's warning, borrowing to invest, or speculating with borrowed money, is like playing Russian roulette. You might be right about the business, but if you're forced to act prematurely because of margin calls or obligations, you can lose anyway. If you want to invest for the long term, stay away from heavy leverage. 5. Missing the forest for the trees. When Buffett evaluates a company, he focuses on 3 things: the future economics of the business and industry, the management, and the price. He doesn't get bogged down in every minor detail. If you lose yourself in endless minutia, you may miss the big picture. Make sure you're seeing the business as a whole. 6. Trying to jump over 7-foot bars. Fancy forecasts, complex math, exotic models, they often impress, but they don't necessarily pay off. Buffett and his partner Charlie Munger prefer simplicity. If you can find a company you understand well, with a straightforward model, honest management, and you pay a fair price, you don't need to leap over 7-foot bars. Simplicity often wins in investing. 7. Narrowing your universe of opportunities. Too much. Buffett says his investment universe is wide. He doesn't limit himself unnecessarily by sector or style. Opportunities move and change. If you only fish in one pond, you might miss the fish swimming somewhere else. While staying in your circle of competence is smart, don't let it become a cage. 8. Feeling pressure to be busy all the time. If you feel you must buy stocks every week or trade constantly, you're probably making a mistake. Buffett likens good investing to a baseball player who doesn't swing at every pitch. He waits for the fat pitch. Inaction is often rewarded in investing. Wait for the right opportunity. 9. Over-diversifying. When you know what you're doing. Buffett's view: if you truly understand some businesses, you don't need to own dozens of them. He said owning more than 6 good businesses might dilute your returns. Your 7th or 8th best idea rarely beats your top ideas. If you're an informed investor, concentration can work, but only if you've done your homework. 10. Succumbing to confirmation. Bias. Our brains love to interpret new data so that it supports our existing beliefs. Buffett and Munger have admitted they've made big mistakes because they refused to rethink something they believed in. As an investor, you should force yourself to ask, what could go wrong, and constantly test your assumptions. 11. Following the herd. When everyone is doing something, it's often the wrong time, especially in investing. Buffett quotes fellow investor Howard Marks, "What's clear to the broad consensus of investors is almost always wrong." If your friends and social circle all love the latest hot stock, maybe step back and ask why you should invest in it. Be contrarian when the evidence says so. 12. The mistake of omission. Finally, and perhaps most painfully, the biggest mistakes are often what you didn't do. Buffett says the worst errors for his company were times when he knew something was within his competence, but he sat on his hands, waiting for the right price or letting the opportunity slip. If you identify something you understand well and believe in, don't linger too long or wait for perfection. So those are the 12 investing sins that Buffett highlights and that many of us are guilty of. Which one have you committed or are still vulnerable to? Drop it in the comments below and let's learn together. If you'd like more deep dives into Buffett's most important investments, hit that subscribe button, give this video a like, and ring the bell so you don't miss future content. Thanks for watching, see you next time, and happy investing.